Hello family, welcome to the channel. Hit that like button for me because I'm going to share with you something that can greatly benefit both buyers and sellers in this very crazy and hectic real estate market. Stick around. Today we are diving into a topic that's a bit off the beaten path, but could potentially save you buyers thousands of dollars and add thousands of dollars into sellers' pockets. Today we are going to talk about assumable mortgages. As always, we're going to break down the pros and cons of assumable mortgages and how it impacts both buyers and sellers. If you're new here, don't forget to hit that subscribe button and turn on the notification bell so you don't miss out on any future videos. I'm Sir Ashley, and on this channel we talk about real estate, personal finance, and the greater Charlotte area. An assumable mortgage allows a home buyer to take over a home seller's loan. Instead of getting a new mortgage, the buyer gets the benefit of a mortgage rate and repayment period and balance and other terms that was negotiated when the seller got their mortgage. Now, I know I just said a lot, so let me back up a little bit. With an assumable mortgage, the buyer gets the benefit of the mortgage rate. So if the seller, when they bought the home, had a 3% mortgage, you, the buyer, are able to step right in the place of the seller at that 3% mortgage. And you get to step in for the repayment period. Let's say they got a 30-year fixed loan, but there's only 25 years left on the mortgage. That means you only have 25 years left on your mortgage. And the reason why this is so powerful, especially right now, because if you're in the market to buy or sell a home presently, there's a 100% chance that you've heard about interest rates creeping up in the high sixes, if not crossing over the 7% mark. In fact, at the present moment, while I'm filming this, the 30-year fixed mortgage is at 7.18%. And that's for people with very good credit. If you don't have very good credit, you can look at rates in the 8s, if not 9s. But according to the Federal Finance Housing Agency, homeowners, meaning sellers, have locked in very low rates. In fact, 26% of homeowners have mortgage rates under 3%. And a whopping 70.7% of mortgage holders have a rate under 4%. And 91% of borrowers have an interest rate of under 5%. Now, I put out a video last week where I talked about mortgage payments and how they've increased over $700 a month because rates right now are above 7%, but last year this time they were at 5.3, 5.4% for a 30-year fixed. So if you're able to assume a seller's mortgage, we're talking about saving at least $700 a month off of your monthly mortgage payment. Truly powerful and can save you tons of money. Now, before we talk about the pros and cons of an assumable mortgage, let's quickly touch on what you need to assume a mortgage as a buyer. For starters, if the homeowner has a conventional mortgage, it will not be eligible to be assumed. For a mortgage to be assumed or be assumable, it has to be a government-backed mortgage, meaning an FHA mortgage, a VA mortgage, or a USDA loan. So yes, that limits the number of potential home sellers that are able to offer assumable mortgages because conventional mortgages is by far the most common type of mortgage. Next, if you're trying to assume a mortgage, you need these three things. Now, these should not come as a surprise to you because for any mortgage, you need these three things. You need credit worthiness, a track record of employment, and income. So quick recap. In order for a mortgage to be assumed, it has to be a government-backed loan, FHA, VA, or USDA. And as a buyer, you need to show three things: credit worthiness, employment, and income, meaning your debt to income ratio. Now let's talk about the pros and cons for assumable mortgages. First, let's talk about the pros for buyers. Buyers, you could potentially save yourself thousands of dollars a year. Now, if the current interest rate is higher than the seller's interest rate, and according to the numbers, there's a 96% chance that the seller's interest rate is lower than the present rate right now, then you'll be getting a real bargain. Two, it may require a lower down payment depending on the existing equity in the home. Buyers can also benefit immediately because there are no lender fees nor appraisal costs. So you just cut down on your closing costs when buying that home or assuming that mortgage. But the main advantage for buyers is securing the lower interest rate and potentially saving thousands of dollars over the life of the loan. Now, with any financial decision, there are some drawbacks. So let's talk about the cons for buyers. Now, the biggest con for buyer is depending on the equity, there may be a substantial down payment you may have to put on the property, or you might have to take out a second mortgage. Now, home values have increased 25 to 40% over the past 2 to 3 years. So depending on when the seller bought the home, there could be a significant amount of equity that is owed to them. So you, the buyer, would have to cover the difference if the home's price exceeds the loan balance. And you can come up with that difference a couple ways. One, if you have a lot of cash, you can just pay that difference with cash. Two, which is a little bit more difficult, is you can take out a second mortgage. And a lot of mortgage lenders aren't too keen right now on offering second mortgages in this uncertain environment. But regardless, for you buyers out there, even after you aggregate the interest rates between the current loan that the seller has and the second mortgage you have, it will still more than likely be lower than today's present rate of 7.18%, and you'll still end up saving thousands of dollars a year. Now let me talk to the sellers. Let's first talk about the pros to sellers that are selling a home with an assumable mortgage. The first pro when selling a home with an assumable mortgage is that your home will be that much more attractive to buyers, especially in this market with a high interest rate environment. You see, when rates are 6, 7, 8%, if a seller has an assumable mortgage that is a 2, 3, 4, or even 5%, it will garner a lot of interest and a lot of attention, and more than likely will sell well above the asking price, because not a lot of people can afford a home at these 6, 7, 8% mortgage interest rates. But the buyer pool just got a lot larger if you're offering a 2, 3, or 4% interest rate. More people can qualify for that home and that monthly payment. So with that additional competition, that means that's going to drive the price of your home up. The second pro for sellers is that it is a lot cheaper closing process. So that is more money in your pocket and in your bank account. Now, it's not all sunshine and rainbows for sellers. I have to talk about the cons, so be sure to listen to those, because there's one huge con that can negate all the pros of doing an assumable mortgage. Stick around. The first con for an assumable mortgage is that not all buyers will be able to qualify to assume that mortgage. You see, as I said earlier, that there are qualifications and stipulations to be able to assume a mortgage. And your lender may not approve all buyers because, as I said, buyers have to have a credit worthiness that meets the lender standards. They have to have an employment history that meets the lender standards, and they have to have an income, debt to income ratio that meets the lender's standards. And if the buyers cannot meet those standards, then you won't be able to find a buyer to take over your assumable mortgage. Now, this next con is what I was talking about. It's a huge poison pill. That's why you have to make sure, as a seller, you're working with and partnering with, a mortgage broker that is comfortable and knowledgeable in dealing with these types of products when selling them to the public. Because if not done correctly, you, the home seller, may still be responsible if the new homeowner defaults on the loan. You heard that correctly. You, the seller of an assumable mortgage, if not done properly, will be responsible if that buyer fails to make a payment. Their default would end up on your credit report. You don't need that burden. You don't need that stress. So make sure when you're selling a home with an assumable mortgage that you get released by the lender from all debts and obligations as it pertains to the loan. And this is where partnering up with a real estate agent that is knowledgeable and experienced in dealing with these types of loans is very key. And because of the environment we've been in the past 10 to 15 years, not many real estate agents are familiar or even comfortable dealing with assumable mortgages. So you have to be able to search those people out and ask the right questions. Now, if you're in the Carolinas, please don't hesitate. Reach out to my team and I. We can definitely help you and represent you in getting your home sold and making sure that you are released from all debt obligations when you do sell your assumable mortgage. Well, there you have it. This is the way in which you can get a 2, 3, or 4% interest rate in today's high interest rate environments of 7, 8%. Go ahead and share this video. And as always, remember to consult with a real estate professional or financial advisor before making big decisions. I'm Sir Ashley, your real estate advisor. Talk soon.